So we want to make sure that we have a component of redeemable gold, whatever that new monetary system is going to be. We have to demand it. They will not just do it if we don't demand it. That's why I'm here in Australia, quite honestly, is to build that global movement, that global citizens for sound money, so that if we can get 3% of the global population to convert their garbage fiat into real, tangible, fundamental gold and silver physical form, we can demand that. So, yeah.
According to Lynette Zang, the real issue lies in the growing disconnect between physical gold and silver and the paper markets that are used to price them. These paper instruments, such as futures contracts and derivatives, are heavily influenced by leverage and speculative behavior, which can push prices far beyond what underlying fundamentals would normally justify. In this framework, physical gold and silver continue to hold enduring value, supported by global demand, industrial use, and their historical role as a store of wealth. Rather than signaling weakness, periods of sharp price movement may actually reflect stress within the broader financial system. The conversation also expands into the realm of monetary policy and sovereign debt, where confidence in fiat currencies and government bonds is increasingly being tested. As central banks navigate rising debt levels and economic uncertainty, the role of hard assets becomes a focal point for those seeking long-term stability. In this context, gold and silver are not just commodities, they are part of a larger discussion about trust, value, and the future of money itself. Now let's hear what she's about to say.
Well, this really does address my personal bugaboo, which is people referring to the spot gold contract as gold or the spot silver contract as silver. Take your pick, because those are two completely different things. And as you know, we've been talking about how speculative those contracts are, being so far away from that 200-day moving average. But I can guarantee you this, and I can't give you tons of guarantees, but I can give you this. The 33 direct users on a global basis of gold and the 36 direct users on a global basis of silver did not evaporate. So what you're looking at is purely a contract. And Harry Dent, which I'd love to sit down and have a direct conversation with him. If anybody knows him, let's invite him on the channel. He is falling into what most people fall into, because when you're listening to the talking heads, they don't say spot gold, spot silver contracts. They say gold and silver. And so what he's referring to, and I know this is what he's referring to, and what the talking heads are referring to are the spot contracts. And yep, they're very volatile because they went into a speculative rise. I mean, silver 70% away from a 200-day moving average, when a lot is 10%. Give me a break. So that's what he's really referring to. The real users of physical gold and silver did not evaporate. So that's the first part of that. And that's what the bubble is that he's referring to, the contracts, not gold. And the treasuries for a year or more are the only safe haven. Why? Because the government can print the money to repay those treasuries. That's why. But what happens to the purchasing power of the currencies when they do that? That's what happens. It continues to go down. And we already officially have 3 cents left. This is it. So when we go into this hyperinflationary piece, which I think is going to be obvious by the end of this year, when we go into that next piece, yeah, debt, because what are treasuries? Treasuries are debt. That's what they are. Now, Kenneth, do you want to add more to that?
How would someone realistically use gold and silver to pay for goods and services?
Well, if all of the other cash registers are turned off and we're in a hyperinflationary stage, then we can understand what is most likely to happen by looking at other countries like Venezuela, where in particularly the outskirts. But and I will be doing a piece on this, and we've done it before, on how you actually use it. But what you will find is you will go into the store and things will be priced in terms of grams of gold, grams of silver, and then probably whatever the local currency is. Because let me tell you, once we're in hyperinflation, nobody really wants the currency anyway, but they still need goods and services. You still need food. You still need all of those things. So everything will be priced more than likely in all of those choices. And then if you've got gold and silver, you're rocking and rolling.
It's a contract price. It's a, I think you and I could agree, an instrument for Wall Street. It's not to serve you and me for price discovery.
Exactly. And remember too, that is shifting, and that started over a year ago now. So where the paper contracts dictate the price discovery to the physical metals themselves and a true supply and demand market. So I really, treasures are for a year or more are the only safe haven. Really, anybody know Harry? Let's have that conversation, because I don't think he knows what he's talking about. He's talking about a short-term trade. And guess what? We may live our lives on a day-to-day basis, but if you do not look to the future and the truth and understand how much these are really worth in terms of these fiat money, wherever you are in the world, that is simply going away. So it is not gold that's dangerous. Bitcoin is very dangerous, because that is a Trojan horse, and that's designed to get you corralled into the surveillance economy. And we don't really want to do that. So we want to make sure that we have a component of redeemable gold, whatever that new monetary system is going to be. We have to demand it. They will not just do it if we don't demand it. That's why I'm here in Australia, quite honestly, is to build that global movement, that global citizens for sound money, so that if we can get 3% of the global population to convert their garbage fiat into real, tangible, fundamental gold and silver physical form, we can demand that. So,
Inflation can drastically reduce the value of money, even if repayments are completed in full. To put it another way, even if you might get the same amount of money back, their purchasing power is frequently far less. Extreme examples from history, such as Venezuela, where unchecked inflation led to the depreciation of the national currency, amply demonstrate this. People start to lose faith in the local currency system in these situations, and regular prices start to deviate from the official currency. When the local currency becomes too erratic to rely on, basic goods and services may even be priced in gold or silver. Energy costs add another major layer of pressure. When oil and fuel prices rise, especially during geopolitical tensions affecting key routes like the Strait of Hormuz, mining operations for gold and silver become more expensive. Since energy is a major input in extraction, higher costs naturally raise the minimum price producers need just to stay profitable. This creates a kind of price floor where miners are less likely to sell below their production cost, which can support higher prices over time.
Is there a fuel shortage, and how will that affect mining?
Yes, indeed. There is a fuel shortage, and there is a huge problem on energy. Even if the war stopped today, even if the Strait of Hormuz were open today, we now have a full-blown energy crisis. And for those of you that were around in the 70s, and the 60s, you might recall that. So the issues around energy are something that also seems to happen every time we are transitioning from one monetary system into the next monetary system. And how will that affect mining? Well, it means that the cost, the all-in cost to mine is going up, because mines take a lot of energy, just like, even the cryptocurrencies, right? But the cost to do it will be going up. And let me tell you, are the miners going to be selling their gold for less than their cost to mine the gold? No, they're not going to. So that's why I said by the end of this year, I think that the maybe not the hyper, because officially hyperinflation is 50% inflation, and I don't know that we would see that by the end of the year, but there's certainly a lot higher and faster inflation that's coming in. And then what that does to consumer confidence which we can see is dipping pretty significantly. And in fact, when I was watching the news here last night, and I haven't had a chance to check it out yet, but they said that the consumer confidence here in Australia has fallen to the lowest level ever. And if that is indeed the case, right, I have to check. I don't hold me to that, because I haven't verified that that was an accurate statement yet. But that could be the tipping point that then creates a domino effect on a global basis.
According to Lynette Zang, there is a significant change taking place in the financial system where prices are determined more and more by paper-based markets rather than by the actual physical supply and demand of metals like gold and silver. This gap, in her opinion, has been widening for more than a year and is indicative of a more serious mismatch between actual physical assets and financial contracts. Zhang is also highly critical of digital assets like Bitcoin, which she describes as a potential Trojan horse for a more controlled and monitored financial system. Instead of relying on purely digital or government-controlled systems, she emphasizes the importance of holding physical, redeemable gold as part of what she believes will be a future monetary reset. She argues that change will not come automatically, but only if people actively demand a return to sound money backed by real assets. She further suggests that we are entering a period where energy shortages and rising costs will play a major role in shaping the economy. Even if geopolitical tensions were to ease, she believes energy constraints would still persist. Because mining gold and silver requires significant energy, higher costs make production more expensive, which naturally raises the minimum price miners are willing to accept. This creates long-term upward pressure on precious metals. Thank you for watching, and see you in the next video.